The market had a rather small gap opening. It's less than 40 handles or so. So again, that's usually not all that exciting. Doesn't mean you can't use it. It just means that's not that exciting. My interest still lies with sticking with the higher time frame because it's an election year, and because of that, uh, I feel like they keep trying to inflate it to make it look like, as a public perspective, is if the stock market's up, the economy's good. It doesn't correlate really. But I like this August 22nd daily high, and we have some smooth highs here that we'll look at. They left those intact last night. No fair value gap has formed yet in the first few minutes of trading. Small little gap there. This is your first presented fair value gap right here, which overlaps new day opening gap studies, which are these levels here. These are relative equal highs. That's what the 214.75 level is. Doesn't have to trade there, but that's where my initial interest is. And then how we trade there. If we just go above it and reject it, that sets the stage for a run up into August 22nd, 24's old daily high, which would obviously have buy side resting above it. But this is just a higher time frame, trying not to pick the top of the marketplace level. So it's kind of like me submitting to the fact that I'm not trying to pick the top in NASDAQ. So if it's going to keep going higher, what would it reach for next if it's going to go above? These are relative equal highs. August 22nd high would be an interesting area for me. We've already swept this here. And let's take a quick look at that little premium wick. I apologize. I have seasonal allergies that I can't promise I'm going to be able to hit the mute button every time I have to do something like that. It would annoy me. So I can sympathize for people that don't like to hear things like that. But I'm human. So you can see we went right to consequent encouragement there. So whenever you're looking at old highs, it's real important that you're watching inside of these turning points. Wherever there's a wick, go right to the midpoint of that. And many times you're going to get intel that you otherwise wouldn't notice. You also notice that many times when I'm taking profits on trades, even if I'm looking for a level like 2114.75 as a run for buy side, if that has a wick like that, just below that, that would be a partial for me. Like I would start scaling out as it's entering into that mid gap or mid wick, which is a gap, and then wait for it to offer opportunity to give up 214.75. So that's how I use wicks for targeting our partials. All right, we're down inside the first presented fair value gap of today. We're inside this fair value gap here. Not that we discard entirely the 930 if there is a fair value gap there. It's just I like to do the first presented fair value gap that's not on the 930 candle. Now, if it wants to go higher, that first presented fair value gap, if it's bullish, we want to see it trade into it and treat it as an inversion fair value gap. Otherwise, if we break below this one here, this could be treated as an inversion fair value gap to trade lower. But I'm sticking with the initial higher time frame. I'm not trying to pick the top. So we're inside of the fair value gap over here, first presented fair value gap. We want to see it maintain its ability to stay in here and then work towards this high. That's what I would like to see personally. I'm subscribing to that view. I've submitted myself to that idea. So you can see how we fell short of reaching into that 20,214.75 level. Traded all the way back down to the 930 fair value gap. We're inside of and now working the top of the first presented fair value gap, which formed on the 933 candle. We would want to see if it trades up above this high. We want to see it energetic speed, a lot of energy to get through that candlestick's wick, midpoint or consequent encroachment. And I personally want to see it just drive right on through 214.75 like it stole it. Like I want to see it just try to run away. Because again, my interest lies with that level up there. And it's just, again, it's just a higher time frame draw. There's nothing saying it needs to go here. It's just, it would confirm to me that the higher time frame still is in very much a buy program. And sticking to intraday longs would be the most appropriate. If you're going to trade with the largest leverage, it would be more appropriate to trade it on that side of the market versus shorting with the highest leverage. Not that you can't make money shorting. It just means that by removing the likelihood of having an over leveraged trade on the wrong side of the marketplace is theoretically less likely to occur if you do it that way. That's my thought process on it. Doesn't mean it's 100%. It just means that's how I go about doing it. All right, so we're making relative equal highs here. Trading back down into the first percentile fair value gap. I'm going to remove the new day opening gap studies here because essentially the information that they're providing is no different than what the first percentile fair value gap is, so it keeps the chart a little bit cleaner. Okay, wicking down into consequent encroachment, just past it a little bit. That's all normal. We have this wick in here. As you're surveying price, every turning point or every consolidation, always try to look for inefficiencies. That means just a fair value gap of some kind or a wick. If there's a long drawn out candlestick wick to the bottom of a candle or above a candle's high, always be mindful of that midpoint because it gives you like a framework, not a framework, like a foothold or a handhold for price to use. And they're not the very strongest ones, kind of like a volume imbalance. The volume imbalance is one like this, the separation between these two candlesticks bodies right there. That's a volume imbalance. They're the weakest. Now I say that not in a way that is derogatory. It's weakest in terms of allowing price to move back and forth through them. So I'm more flexible with them. They can be used as an entry model. For instance, we just went down consequent encroachment. We had this one here, traded back above, and now we went down into it there. It could use that as a foothold to trade up to the relative equal highs, or it can go lower one more time and then use this at a later time. It's just how hard are you fixed on your immediate draw, what you're trying to trade on. I like to use them while I'm in a trade that is really working well for me. And if they start responding well in that, it gives me a lot of confidence holding on to the setup, especially if it's a large position. But they're the least in terms of rigidness. I guess the easiest way to describe it that way would be, whereas an order block, it's pretty standard that on a down close candle that would be representing a bullish order block. That would be best seen with the opening price down to the mean threshold, which is the middle of the candlestick. I don't want to see any body of another trading candle go lower than that. Preferably, I'd like to see it just touch the opening price and then stop right there and start going higher. That's a perfect world. That's a perfect delivery of bullish order block. But for volume imbalances, they can be you got to be real flexible with them. And I've seen students that have, because everybody wants to pick their own specific PDA rate. They want to learn from me, but they want to have their own pathway into what PDA rate they're going to use. There's a fair value gap here. We just trade that into it. That's institutional order flow entry hero right there. They have their hearts broken basically because sometimes they expect the volume imbalances to be rigid. They expect them to be definitive about stopping price. And if I don't have them, and I'm the author of that concept, employing it in price action, if I don't hold that degree of importance over them, why should you? So it's not to be discouraging to you about it. It just means that you have to have the expectation that the characteristics around that specific PD array, you have to be, flexibility is the key thing. All right, so we just bumped the relative equal highs here, and we still haven't traded to the 20,214.75 level. You want to screenshot that, by the way, as I was talking about that volume imbalance. You can see how it behaved that way. Trading down to consequent encroachment of the first percentage fair value gap. Traded back up and back down into that volume imbalance. See what the bodies are? That supports the volume imbalance. The wicks do the damage, it's fine. And rallied up to the relative equal highs. That could be your setup. That could be your model. So in a perfect world, I would like to see it not lose ground and go below this fair value gap. Okay, so what I'm saying here is these relative equal highs, we're going to take this off now. Okay, and this is that wick that I had over here on this time frame. That's this candlestick's premium consequent encroachment of the wick right over here. On a 5-minute chart, all these candlesticks here is a wick. That's that one right there. See? So since we're above it now, we don't need to worry with it. Clean your chart off. And because we're above those that old 20,214.75 level, we are accumulating in here, which is exactly what you want to see. And I was mentioning down here, I don't want to see it trade below this. So this would be represented by hopefully a breakaway gap that would lead to a run above that 214.75 level. And then to see if we can run up into the August 22nd high. And that would make a beautiful session this morning. But this, if you were in a long, you would be wanting to take profits as you're engaging that 22nd high. Like that right there would have been a real nice area to start distributing some of your long position. And any remaining portion should have it stop below here. You should have no reason for it to go back down there unless it wants to go lower. Think about how we were talking about the first presented fair value gap. When we traded down, relaxing, not forcing anything, the market traded down into the 930. This is a 15-second chart, but it's this. That gap there. So when it traded down there, we weren't freaking out. We gave the market the opportunity to show us what it wants to do. Our bias, well, my bias that I shared with you was the 20,214.75 level. And then on a best case scenario, drawing to August 22nd high, which we don't need that. But because we have two pools of liquidity there, it's reasonable to expect it to try to make an attempt to get there. It need not get there entirely to this high, but we think that it's logical to start looking for setups that would be used for something like that. That means when the market did drop down here, did it spend a lot of time inside that gap? Remember what I was teaching the last few times when we were in live stream? Inefficiencies, you don't want to see it staying inside the inefficiency and you're camping out. We don't want it staying in there making lots of candlesticks forming inside the inefficiency, because if the market's being delivered to that inefficiency, the algo is letting price get there for a moment because smart money should already be expecting it to trade down there to onboard new long positions. I gave you the process of thinking, let it get back to the first presented fair value gap, trade above it, and treat it as what? Inversion. That's how you would use the first presented fair value gap today with this market structure. I was not ambiguous about it. The only thing I said was give it a chance, because if it fails here and doesn't go higher, then if it goes lower, this will be treated as inversion fair value gap. And we'll have to worry about this at a later time. But if it rallies back up to this one, it needs to go above it. Come back down in. Look at the bodies. That's the upper quadrant of that inefficiency. Let's see if it wants to trade it at August 22nd first, before I start stripping down a little bit more detail. While we're looking to see if it'll do it, this over here was just simply me using a 1 minute buy side and balance, sell side inefficiency, and in close proximity to yesterday's first presented fair value gap. So I was thinking that they were using it here, and retail sees these things like this as support. I want to get in there as it goes down below it, and it trades right into that little inefficiency there. So that was my entry, expecting it to trade up into, perfect scenario would be trading up to August 22nd's high. But this admittedly was where I was looking to bail. And a quick little summary here. The initial run, that is not a juice swing. It's just simply, it's trying to get somewhere. And it was going to go to that 214.75 level because they're smooth highs. They left them in place yesterday. And then this gap, while it's not considered the first presented fair value gap, by definition, it is a fair value gap. So you have to look at it and consider it. But this is the first presented fair value gap. So what's the difference? First presented fair value gap is going to be utilized for a signal or a setup that my son will use. So this is where Caleb takes his trade. Later on, when he gets better at looking at information in price action, he may take this long here and then add to it here. But his father is telling him this is how you're going to use it. If it's down here, okay, it was in a hurry to get down there. That means it repriced there. So it offered the sell side in that little area. It did not spend a lot of time in it. These are 1 minute candles. So it went down, one more candle, and then on the third candle, it's leaving. Elvis has left the building. And while we're down here, I said, we want to see if it's going to be bullish. It's going to trade up to the first presented fair value gap, trade above it, and come back down in. Is that looking at that little inefficiency there? I'll say this and then we're done. It says candles high, that candle's low. But here's the lower quadrant of that inefficiency here. Look at that. Isn't that beautiful? It spikes down with its wick, leaves what? This drop back down in leaves the lower portion untouched. Yes, we traded to it here. Yes, we traded up through it, the lower quadrant through here. But what I said was when we were down here, it needs to trade up through it and go above it and come back down into it. So when it's diving down into it, you got to look at that. This is the first time it's using it as what? Inversion. So it's going to do what? In a perfect world, leave the lower half untouched. Well, it trades down to the lower quadrant, but it leaves the lowest portion open. That's exactly what you're looking for an inversion fair value gap. This is the signature that the algorithm is absolutely going to send it higher. There's no ambiguous confliction. There's no arguing about it. It is absolutely telling you that that's exactly what you expect. And then the bodies stay where? In the upper half from that red level here up to the top. In other words, at 20,179 to 184.75, the bodies are perfect if they're inside that range, which is the upper half of that orange box that's represented by this candlestick's low and this candlestick's high. And then we use the upper quadrant level 2 and then sends it.